Gold can fall hard in minutes, even when the headlines sound like pure fuel for a rally and charts look fine. The move is often not about inflation, war, or panic, but about a trade that looks almost riskless on paper. It is treated like a safe spread, a quiet harvest of tiny yields, and it can turn into a metal trap. When that trap snaps shut, the unwind can dump gold and silver faster than most charts can justify. To see it, you have to stop thinking like a coin buyer and start thinking like a balance sheet under pressure. Because this trade lives in funding markets, margin rules, and the thin plumbing behind futures. The basic idea is simple, and that simplicity is exactly why so many smart people crowd into it with leverage. Traders buy metal in the spot market or through an ETF, and they sell futures against it as a hedge. They lock in the price difference between spot and futures, and they call it the carry. In normal times, futures trade a bit higher because storage, insurance, and financing are real costs. If that futures premium is large enough, the spread can look like a steady interest payment with minimal drama. Buy the metal, sell the future, park the position, and wait for time to close the gap while costs stay tame. It sounds boring, and boring is seductive when other markets feel like a casino. On a spreadsheet, the directional risk looks muted because the long and short seem to offset. That is why desks label it low risk, and why leverage quietly enters through the back door in good times. Funding the metal is the heartbeat, and that funding can come from repos, swaps, or bank credit lines. As long as money is easy and margin is stable, the trade feels like free lunch with a tiny fee. But safe trades do not die from price moves up front. They die from liquidity shocks and sudden rule changes. A sudden jump in funding costs can flip the math from carry to burn, even if metals barely move early on. At the same time, futures exchanges can raise margins when volatility wakes up and risk models get nervous. Now, the trader needs more cash right now, even if the spread is still theoretically fine. And the quickest source of cash is the position itself, so the unwind begins with a fire drill. Unwinding means buying back the futures short and selling the metal that was held as the hedge and collateral. The futures buying can look supportive, but the physical or ETF selling hits the market like sudden weight. In gold, it can feel like gravity, and in silver, it can feel like the floor dropping out. Why does it hit so fast if the trade is supposed to be orderly and hedged? Because crowded trades are never orderly when the same risk managers read the same screens. They all see the same funding spike, the same margin email, the same volatility jump. Then everyone reaches for the exit at once, and the exit is narrower than it looked in calm weather. There's another twist that makes the dump sharper than people expect. Many players do not hold bars in a vault they control. They hold claims that must stay liquid. If an ETF share has to be sold to meet margin, it is sold without emotion and without debate. That sale forces authorized players to redeem or hedge, pulling more metal exposure off the table. Also, a lot of this trade is run inside banks that manage balance sheet limits tightly. When those limits tighten, desks shrink inventory, and the inventory that goes fastest is the financed position. Now add a stronger dollar or a flight into cash, and you get a double squeeze on metals. Not because the metal story changed, but because the funding story changed. Think of it like this. The trade is a bridge made of credit, and the metal is just the cargo. When the bridge shakes, nobody argues about fundamentals. They just drop the cargo to survive and get liquid. Silver suffers even more because it is thinner, more volatile, and more sensitive to forced selling. And once the drop begins, the next leg often comes from the market structure itself. Stops trigger, trend models flip, and options dealers hedge in ways that accelerate the move. That is how a small funding problem becomes a big price move that feels like manipulation. It usually is not a villain. It is a system doing what it is built to do under stress. Here's the part most investors miss. The unwind can start while the news is bullish for metals. The trade is not reacting to the story. It is reacting to the cost of holding the story. When money is scarce, even the best narrative becomes a luxury item on a margin statement. So what actually flips the switch from carry trade to unwind event? Watch the futures curve, especially when it flattens suddenly or slips toward backwardation. A flattening curve crushes the carry that justified the trade, and it does it quickly. Watch funding indicators like repo stress, swap spreads, and the general price of short-term dollars. When those jump, the trade becomes expensive even if the metal price is calm. Watch margin changes, because higher margin is a direct demand for cash. Watch volatility, because higher volatility turns risk models from friendly to ruthless. Watch delivery chatter, because delivery risk forces hedges to behave differently. Watch liquidity hours, because the sharpest drops often happen when books are thin. Now let us walk through the unwind as if you were sitting at the desk when the alarm hits. Funding cost jumps, and the spread that paid you yesterday now costs you to hold today. Risk calls, margin calls, and suddenly your position is not a spread, it is a cash drain. You start by reducing size, but the market is moving and your hedge is not as clean as it looked. You buy back futures to close the short because that leg is liquid and easy to execute. Then you sell spot exposure, often through ETFs or large blocks, because you need cash immediately. As those sales hit, metal prices slide, and that slide increases stress for everyone still holding. More desks reduce, more funds to risk, and what was a gentle carry becomes a forced liquidation wave. At this point, the chart tells a scary story, and the story pulls in more sellers. People who never ran the spread see the drop and assume something is fundamentally wrong behind the headlines. That fear creates new selling, and it feeds the unwind even though it did not start it. This is why the trade is called safe right until the moment it is the opposite of safe. The risk is not that the spread fails in the long run. The risk is that you cannot fund it today. In markets, surviving the day matters more than being right about the year. So what can you do with this? If you trade metals, or if you hold them as protection in a broader portfolio, start by respecting that metals can be sold for reasons that have nothing to do with the metal itself. If you are long for the long term, forced selling can be opportunity, but only if you have patience. If you are leveraged, forced selling can be ruin because the market chooses the timing, not you. Keep your metal exposure sized so you can hold through a funding storm without panic decisions or forced exits. Pay attention to the curve because it is the heartbeat of carry and it signals stress early. Pay attention to the dollar funding pulse because it is the hidden gravity on all hard assets. Do not treat a sharp drop as proof the thesis is dead. Treat it as a question about the plumbing. Ask whether the move smells like liquidation, with speed, thin volume, and broad risk reduction across assets. Then ask whether the conditions that cause the unwind are easing or still tightening. When the pressure eases, the same mechanics can work in reverse and metals can rebound fast. Because the unwind that dumped the market can become a scramble to rebuild exposure as fear turns back to chase. That is why understanding this trade matters, even if you never touch a futures contract. It helps you read panic moves with clarity, and it helps you avoid selling into the wrong cause. If you want, I can break down real-time signals that show when the carry is crowding again. And I can show how to map those signals to your own risk, so metals work for you, not against you. Finally, the safe metal position is the position you can hold when the safe trades are forced to sell.